The Schwab US Dividend Equity ETF, or SCHD, has always been one of my favorite ETFs, and as of right now is an ETF that I pretty much buy at least a share or two of on a daily basis. Now, some of the reasons being that the total expense ratio is super cheap, so it doesn't cost much to own, and I'm a big fan of the methodology of the Dow Jones US Dividend 100 Index, which has screenings that are pretty rigorous and makes it hard for stocks to enter the index. Now, on top of that, SCHD has done pretty well historically as far as total return goes. Looking at just the ETF price return up around 170%, not even including dividends. Also, things like SCHD's dividend growth rate has been a huge selling factor on why I buy this ETF on a daily basis. The dividend growth has been pretty substantial over the last 10 or so years when it comes to SCHD. But as time goes on, there are certain things that I'm not necessarily sure about when it comes to SCHD. Things like the top 10 holdings. Currently right now, things like Amgen, AbbVie, Broadcom, Merck, Chevron, Pfizer, Cisco, Texas Instrument, PepsiCo, Verizon are the top 10 holdings out of around 100 different holdings or so. Now, I say I'm not really sure about these top 10 holdings because between you and I wouldn't necessarily have a few of these in this list if it was up to me. And I think we all pretty much know which stocks out of these we like and don't like. Also, things like the holding breakdown as far as sectors go, I'm not the biggest fan of having industrials be the #1 position because I personally do think that there's other sectors that have more growth potential. So in this video, we're going to be going through a newer ETF that I came across as of recently, and I'm going to start probably buying a lot more of as time goes on and slowly phase away from my daily purchases of SCHD into this new super high quality dividend growth ETF. Now, if this is something that interests you, make sure to drop a like down below, subscribe, and let's get right into it. So the ETF that I'm talking about, the ETF that I think is sort of comparable to that of the SCHD as far as an ETF that I want to purchase pretty much on a daily basis, which is what I'm doing currently when it comes to SCHD, is ticker symbol DGRW, or the Wisdom Tree US Quality Dividend Growth Fund. Now, this is an ETF that I came across as of recently. I know it's been around for a while, but I guess I'm a little bit late to the party. It says Wisdom Tree US Quality Dividend Growth Fund seeks to track the results of dividend-paying large-cap companies with growth characteristics in U.S. equity markets. Now, when it comes to DGRW, or the Wisdom Tree U.S. Quality Dividend Growth Fund, by first glance, it looks sort of comparable to that of SCHD if you were to look at just the charts alone in the max time frame. But to be more specific, DGRW is up around 160% as far as all time goes, and that's not dividends included. Now, just to get it out of the way, one of my least favorite things about this ETF, DGRW, is the expense ratio right here, 0.28%, which is much higher than SCHD's 0.06%. So there's not really any way around it. That's definitely a much higher expense ratio, which is definitely going to add up over time as I plan on acquiring more and more shares. But that right there is probably, for the most part, the only thing about this ETF that I honestly don't like. Now, to get to the part of this ETF that I like the most, the holding breakdowns. I love this breakdown as far as sectors. Technology being 30.7% as of right now. Now, I do like technology, of course, because of the growth potential. Technology stocks, although, don't necessarily pay that high of a dividend, so you are going to have to take the good with the bad. But because technology is around 30%, it's not necessarily overly too much of the overall ETF, but it still is a majority, which I like. Next, we have consumer defensive, also lots of growth characteristic stocks in there, with 15.83% of it. Then we have around 14% industrials, 14% healthcare, 11% financials, 9% consumer cyclical, and then the rest is basic materials, real estate, energy, utilities, and communication, all around 1 or 2%. So far, you have to admit that the holding breakdown looks pretty good as far as sectors go, especially for a relatively younger dividend growth investor that does have some time ahead of him. Now, the top 10 holdings is really what sold me when it comes to this ETF. I'm a huge fan of these top 10 holdings, and not to mention the fact that DGRW has almost 300 different holdings compared to SCHD's around 100 holdings. Now, I personally like to have more holdings, more diversification, just in case there are a few bad apples in the bunch. As we've seen over the past year when it comes to SCHD, a few of the bad apples have definitely dragged down the ETF quite substantially. And the fact that some of the top sectors in SCHD have dragged down the ETF substantially, that's something that I probably want to get away from moving forward. But DGRW's top holdings, things like Microsoft, obviously one of the best companies in the world, and a company that I definitely want more exposure to moving forward. Companies like Apple, 6% of the ETF is Apple. I love Apple. I currently have around 1,000 shares of Apple in my long-term portfolio, and Apple is definitely a holding that I want to have some exposure to probably forever. Then we have companies like Broadcom, Johnson & Johnson, Procter & Gamble, the Home Depot, Merck, Cisco, Walmart, and Philip Morris. So there's a really good mix of super high quality companies. There are some in here that of course have giant starting dividend yields, like Philip Morris, which is definitely going to of course help the overall dividend yield of the ETF. But there's also companies in here that have massive growth potential, which again, even though I'm more of an income dividend focused investor personally, that's just my personal preference, I do still want to have some exposure to growth names like Microsoft, Apple, and others. Now, when it comes to DGRW, the dividend yield starting is going to be about half that, more or less, of the SCHD ETF, which doesn't necessarily make me thrilled because I do love adding more ETFs and stocks on pretty much a daily basis, and knowing that I'm adding quite a bit more cash flow on a yearly basis when it comes to dividends alone. But at a 1.91% trailing 12-month dividend yield, you're more or less buying into DGRW for growth potential with a small amount of cash flow on top of that. But let's be real here, 1.91% is not going to pay the bills today or tomorrow. But to be fair, there has been some good dividend growth as far as the long term. The last 5-year CAGR is 7.17%, and the last 10 years is 23.16%. Not to mention, DGRW pays a dividend monthly, which is sort of just a nice little gesture by the ETF. I don't necessarily care if a stock or ETF pays a dividend monthly, although I don't mind, of course, getting a dividend more frequently because I can reinvest it into whatever I want to buy, or of course, later on in life, use the dividends on a monthly basis to pay for bills or other things. But all in all, looking at the monthly payouts from DGRW over the last, say, 10 or so years, they've been pretty steady, with some months, of course, being bigger than others, but there has been some pretty substantial dividend growth, at least over the last 2 years or so. So now you know some of the reasons on why I dislike SCHD in some cases, and also why I really like DGRW. So now I thought it'd be a little bit fun to sort of compare the two. Imagine we invested $10K into both, the SCHD ETF and DGRW ETF. And imagine we invested $10,000 into both of them back in 2014, January 1st. Now, before we see which ETF returned more and which ETF returned less, comment down below just as a guess which one you think returned more. On the count of 3, 1, 2, 3. So here we go with dividends reinvested. Remember, $10,000 invested into each one of these ETFs. So SCHD with dividends reinvested had a total return of 162%, with an average annual total return of 10.39%, and the $10,000 investment turned into $26,295, which is honestly very impressive. But DGRW, the $10,000 investment, had a total return of 182.23%, with an average annual total return of 11.19%. So DGRW actually outperformed the SCHD ETF on this given time frame. Now, obviously, with dividends not included, it's more of the same. DGRW wins, but honestly, they're both neck and neck for the most part. And in my opinion, being a more dividend growth focused investor, I think either one of them could be a great investment vehicle for long-term wealth. So there we have it. Those are some of the reasons on why I'm a big fan of DGRW and some of the performance it's had historically, etc. Moving forward, I'm likely going to continue to buy SCHD, but I think I am going to sprinkle in some DGRW on top of that over the next 12 months or so. But now I want to hear from you guys down below when it comes to SCHD and DGRW. If you could only invest into one or the other from here on out, comment down below which one you would buy and why. If you enjoyed this video, make sure to please drop a like and subscribe for more future content like this. Thanks as always for stopping by, and if you are interested in investing, make sure to check out these recent videos I posted right here.